Hi, everybody. This is Nita Kapoor, and I have Vikas Kuthiala with me. As promised, today we are going to be covering the basic requirements on finance that we have got a lot of requests from most of you. What Vikas and I will cover essentially is going to be what you need to be understanding and taking care of when you are writing your final pitch with your mentors, which I'm sure has moved now from ideation to clarifications to research work to all the details that you have to take your idea forward. So this is where we will start. The first and the foremost thing you need to really look at in your idea and in discussions with your mentors are what are your sources of revenue, right? Simply put, how are you going to make money? What are the number of sources that you can make money from? So we use words like revenue, we can say sales income, sometimes it will be a service income, but it fundamentally means turnover, money coming in. Right? Plot this down. The second aspect will be to be able to get the money in, what are the kind of costs you need to look into? These could be direct costs and these could be indirect costs. The direct cost will be something like electricity, rental income to be paid. The indirect cost will be where you have to apportion the cost. So, for example, if I've used machinery, if I have used shared services, if I have used a consultant, if I have used any other where I need to apportion a cost, then it is called an indirect cost. So you've got to ensure that all your costs, be it direct and indirect, are listed down and covered. The third is going to be what are your sources of supply? What are these sources? Are they permanent in nature, temporary in nature? Do they fluctuate? Are they consistent? These will help you understand that the nature of volatility or the nature of flexibility or the lack of flexibility in your supply chain, and in case if you need to look at any other options. So to be able to arrive at gross margins, you need to look at revenue or sources of revenue, costs, multiples of costs, also direct and indirect nature of costs, and sources of supply. Once you have these three, you would be able to then arrive at what a gross margin of your project will be. Over to Vikas.
Thanks, Nita. So let me just, let's start from the beginning and the first principles. When you make a business plan, the first question, of course, that you need to answer is what is your service, what is your product, who is your customer? Because that must be very sharply defined. And who is your customer will also define what is the market that you are addressing and the need that you are addressing of the prospective customers in the marketplace. Now, any business relies on one fundamental principle, that is that you have incurred some time and effort and cost in preparing a product or service, and in exchange of that service from your prospective customers, you transact value. And these are all reflected in nominal terms of any currency that you might be dealing in. Let's take the case of India, it will be rupees. As Nita just said, any business will have revenue, but revenue itself might comprise of not one, but more than one range of products, goods, and services. Remember, each product or a service will most likely have a unique price and a unique set of costs associated with that revenue, i.e., what is it that you have spent to create that product or service, and how much are you able to charge from your customers, and any surplus is then defined as the resource that you have developed for your business. Let me get down to the next level of detail. In any venture, startup venture or a mature business, it is driven fundamentally on the sustainability and the soundness of what is popularly called as unit economics, which means that are you able to demonstrate that a unit of product or a unit of service is covering all its costs so that as your business grows, as your revenue grows, the unit economics is viable, that you are a profitable business. It may be possible.
So let me explain unit economics to you better, which means at a single sale level, you are able to show a positive net margin. Your overall EBITDA may be negative, but if you're selling, let's say, for example, one sweater, the margin of selling that one sweater should be positive. That is the key for investors to look at, that as the revenue will grow, the net margin that the company is showing as positive will over a period of time turn the EBITDA into positive. However, depending on a whole host of other issues. But this is the simplistic definition of unit economics.
Okay, thanks, Nita. So back to just trying to drill down a little bit, from the unit economics. You see, it is quite possible that you have unit economics which are viable, as Nita just said, that when you have sold a unit of product or service, you have some gross margin. But it is possible that you have other fixed costs which are very high at the initial stage of your business because you have to promote your products, create new channels, and incur other costs, in which case you probably are not making business at the enterprise level. But these costs are essential for you to grow the business. And because these are essentially fixed costs over time, as your business grows, the scale of the gross margin will be such that all your fixed costs are being covered and you are a profit-making company at the EBITDA level. So let's now explain some of these concepts. When we say direct costs is the first set of costs that you will incur when you are making a product or a service. These are costs that you can directly associate with the making or the manufacturing or preparing a product or a service. A lot of businesses will not win in the long run if their direct costs are higher than a parity competitor. Just to give you a very basic example, if you're manufacturing biscuits and you are buying, let's say, essential things like flour, fat, and sugar, unless you are buying these raw materials at the most competitive price, you will eventually not be able to win versus a competitor who is doing so. So your direct costs go to the heart of your business. It tells you how efficient you are in making the core product or in preparing the core service. So the first element is a direct cost. Then, as Nita said, there are a set of indirect costs. Now, indirect costs can either be fixed or they can be variable. Indirect costs are those that you cannot directly associate or apportion or allocate to a particular product, but you know that these have to be incurred for the full development of your product or service. Now, if you take your revenue and you deduct just the direct costs, that gives you a net margin. Every business, every single business at any stage of its life must have a positive net margin. Let me explain. I go back to the example of flour, sugar, and fat. You can't have a business if you are buying fat, flour, and sugar at 10 rupees each a kilo and making 1 kilo of biscuits and selling it for 25 rupees. Because it means that you have basically not even covered the cost of your raw material, More biscuits you sell, the more you will lose, you will never make any money. So your direct costs must always be positive and must always be healthy. Higher your net margin, the better it is for your business to turn profitable one day. If the margins are low, then you will need a much bigger scale to make profit in the future. So once you have arrived at the net margin, which is revenue minus the direct costs, you come down to now calculating all the indirect costs. Now, indirect costs are going back to the same example. You're manufacturing biscuits, but you also have an office which has salespeople, accounts people, finance people. Now, all these people are also important in your ability to be able to make a carton of biscuits and eventually sell them. But it is not possible to calculate in a very exact, specific manner how many units of these other costs, which are called indirect costs, can be calculated down to each packet of biscuit. So you allocate these costs on some basis or the other. So once you have your net margin and you have deducted the indirect costs from that net margin, you come to a gross margin. Every business must have a positive gross margin. If you don't have a positive gross margin, it is very unlikely that any investor will think that this business one day will make a positive gross margin. They would like to see healthy gross margins.
Right,
Yeah?
because gross margin is a indicator of free cash flows in the future. And it is a must and an essential that needs to be positive, giving the investor the confidence that at some breaking point in the business that you will forecast in your numbers, the company will have cash. Because remember, cash is king.
Okay, now once you have the gross margin, then comes some of the other overhead costs. You have offices, you travel, you spend some time on legal fees, on audit fees. These are also essential overhead costs which are essential for any business to incur. Otherwise, the whole enterprise would not function. Now, even costs like marketing costs will come under the overhead costs because these are costs that you are having to spend to keep your business alive. Once you have a gross margin and you deduct all the general overheads, you arrive at a term called EBITDA, EBITDA, earnings before interest, tax, depreciation, and amortization. Now, if you have a business which is positive at the EBITDA level, it means that every investor will consider you to be a successful, viable, running enterprise. A positive EBITDA is something that occurs in the life of any venture, beyond the initial period of launching a product, testing it, doing various things, and scaling up before you are able to cover up all your indirect costs and your overheads. That might happen sometimes in a startup such as yours, maybe 2, 3, 4 years down the line. So at this point of time, you do not need to worry if you are reporting a positive EBITDA when you start, or that you are even sure if the EBITDA would be positive in the second or third year of your business. Remember, if your venture is solving a problem which was previously unsolved, or solving a problem with a solution which does it in a different way, that is where a lot of marks will go in investors being interested in your venture having sound footing. Then they will want to see if your venture has positive unit economics, that they have net margins which are healthy, that there are gross margins which are positive, and all that you need now is investment support to be able to grow the business and inherently become profitable once the scale of your gross margins are able to pay for all the other fixed costs and overheads that you would incur to run a business. Over and above and all this, investors would also, as we probably have told you in the past, would like to see which market are you working in, how large is the market, what are the possibilities of your venture being able to become in this market, how large it can be, and also, is your value proposition unique in a market where you feel you're addressing specific customers, and if the composition of the team has the right passion, the right commitment, the right focus, the right attitude to be able to deliver success one day, which may also mean that they're looking to see if you people are analytical in your thinking, you're open to suggestions without being dictated by the world outside, and you have the right attitude to remain flexible and pivot your business if it turns out that your initial thesis was not turning out to be as viable as it was, but you always remain in the hunt for a new thesis. It can be an evolution of the old thesis. It can be something which is radically different, but that you remain in the game to be able to find a solution for customers whose previous problems or pains have remained unaddressed. Thank you very much.
Thank you, everybody. Hope this was of some use to you. And do write into us in case if you need some more clarifications. Bye for now.
बंद कर देना।